and welcome to ICICIdirect. Today we are in a conversation on Nippon India Focus Funds with Sailesh Bhan, Deputy CIO, Equity at Nippon Life India Asset Management Limited. Sailesh, thanks for joining, and it's always a pleasure to get your perspective on the markets and everything that's going on. First up, it seems like the markets are once again picking up momentum. It's a 1,000-point move in the last couple of weeks. What are you reading into this? Is this a short-term blip, or the markets are really gaining some confidence, in your opinion?
After 2 very solid years, markets are again trying to understand the large changes which are happening internationally on the macro front and even on the domestic side. And hence you have seen this kind of volatility. The logic the markets are looking at is whether the current conditions today will lead to a significant earnings downgrade in the next, say, 12 months or 18 months is what the markets are trying to figure out. Also, what has happened is because of significant FI selling in the last 12 months or last 6 to 9 months, we have seen certain sectors and all becoming reasonably attractive. So markets are lending greater value to those, and they're finding greater value there and actually participating a bit more there. Like, banking, which has gone out of favor, is now getting some respect and response. And hence, you've seen both combination of stability from reasonable valuations in some pockets of the market, despite whatever macro headwinds, which, will clear out maybe in the next 6-12 months for us.
Sailesh, not just locally, but internationally as well, there are a host of uncertainties. To begin with, inflation, and that's pointing its nose out all over the world, which is also leading to higher rates. There is the war, liquidity squeeze. All of this is now on the horizon. How are you seeing it playing out in the near term and the medium to long term?
The larger risk of inflation, I think this is coming back after a period of nearly maybe 8-10 years, significant rebound in inflation. And hence, and even given where the construct of the market was in terms of very easy money for years together, which is also undergoing a change, I think these are very important factors and will lead to maybe a very different set of performers in the next 1 to 3 years. Secondly, the inflation pressures are just being visible now. So it's been the first 3 months of inflation, which, we are all suffering. And I think the peak inflation will be visible in another next 3 to 6 months, because pass-throughs would have happened in a lot of cases where, companies want to maintain margins. So I think these are factors which will count. They are very important. They will matter. And the only anchor we would have is where there are right and reasonable valuations so that you can navigate through them better. But I think these are factors which are very critical. Inflation, global commodity, the stickiness of global commodity rebound, moving to even food prices and things like that, is clearly an important area of concern.
Sailesh, I think the silver lining is that we've relatively done better than most of our global peers, at least in the last few months. So there is some form of resilience that Indian investors are showing. What are your thoughts on that?
It's been, thankfully, been a very significantly supportive domestic liquidity market, in the sense we have seen retail investors staying the course, investing, adding to systematic investment plans. And that has actually helped us weather the significant FI sell-off as well. Now, the inflow or equity markets as an important asset class for Indian investors is today possibly at its highest point I have seen in the last 27 years into equity markets. And I think this will only get stronger over time. Purely, this money, which has come in the last, say, 12, 18, 24 months also needs to see positive returns. So if you are able to navigate and this money earns positive returns over the next 12, 18 months, you would find that sustenance of the significant flow into equities from domestic side highly likely. Internationally, money flow into India, because of what's happening, reallocation and various other aspects, and Indian markets being relatively more expensive to other comparable investing markets, I think you may have some kind of flow challenges. But on the domestic side, clearly at the moment, the direction is towards increasing allocation to equities, especially with the younger generation also participating very significantly. And more importantly, a systematic investment approach to doing it, I think, which in a way takes advantage of some of the volatility which we see around.
Sailesh, so the old hands will not get rattled. because we all understand the markets are volatile, usually in the near term. But what is the advice you have for first time investors? Because testing or tasting volatility can be very difficult in your early sort of days of investing. What is the advice you have for these first time investors?
See, each one has to live through the volatility period. They just have to remain normal in these kinds of circumstances, because every day, whether it's the media or somebody else, will give a news which will appear that possibly that's the single most important factor to determine longer term returns. And that news gets forgotten 3 months down, 6 months down, right? So directionally, if they just are able to keep time on their side specifically and are not leveraged. See, leverage is a killer in these markets. So if you're not leveraged, if you're able to keep time on your side, and if you're directionally, I would say, a passive investor, in the sense, you want to keep on adding to and taking advantage of it rather than trying to get your returns in a very short period of time. I think this is an opportunity. You see, in most markets, you find it difficult for people to buy something after it goes up, but in equity markets, everybody wants to buy after it goes up, right? So if you have new investors systematically adding to and taking advantage of the volatility on the downside, maybe as clouds clear in the next 6 to 12 months, we could well have a very good earnings cycle post that. So directionally, it's more buying time in the market and zero leverage. I think that is the two things which I think will matter most.
So, in terms of investment advice, Sailesh, what would you tell investors to make investments that match their risk profile, or to generally be more risk averse and stick to safer options, say large cap funds?
See, there is, in equity markets, there's nothing like a safe place, in the sense you have to take some risk to earn returns, right? And within that, you straddle through relatively safer assets, like, maybe large cap is relatively less volatile than others and all. So our approach to this is, yes, you have to match it to your risk profile and use these downturns to keep creating or keeping your asset allocation appropriately aligned, in the sense, depending on the risk appetite, you want 30% equity, 40% equity, 50% equity. Because please don't mess with that, because if you change that at the wrong time in the market, your longer term returns are way inferior. So if you're underinvested in equities, use this downturn with a 3-year view to add on to your positions there, and especially choose maybe a larger cap option more initially till we weather the next 6 months and 12 months. And more importantly, stay the course. Suppose you're over allocated to equities, you can always allocate less or deallocate a bit and wait through as well. But preference over large caps over other categories is only because of the fact that as market conditions continue to remain challenging, you will find these guys being in a far better shape. And you will be in a much better shape 6-12 months out to take a decision if market shifts into other sides, creating an opportunity, because large caps also give you that liquidity, that ability to move capital around.
And Sailesh, in that case, what percentage of your portfolio would you advise clients to be in large caps?
See, typically, we have seen large caps are nearly about 70-75% of India's equity markets by market capitalization. They are that large and that important a category. And clearly, they constitute most of the profits in the country. Right. And their dominance in many, many sectors is like, 50% to 60% or 70% market shares in categories are purely contributed by large cap companies and businesses. So a sizable allocation based on risk profile, maybe if the market is 75%, if you want your risk profile to be market neutral, you're 75% large caps. If you're a younger investor, have a longer term horizon, maybe you could be 50-55% and have the balance in mid and small cap businesses. So it's a bellwether. It's the reflection of where the economy will move, and hence possibly the best available play in India on a risk reward basis.
Sailesh, in that case, then it's fair to say that large caps offer the best margin of safety in the current volatile times?
Yes, within the available categories of large and mid and small cap investing, the margin of safety clearly is the highest in the large cap space. And more so because they will be the best guys to weather inflation. They actually get the least amount of impact because they are able to pass on to various ancillary suppliers. And their ability to price products is way better than small and mid cap companies in this current environment. And luckily in India today, the large cap companies are also not leveraged so much. So they have an ability to over time, add on to leverage if required from a business point of view to scale up growth. And I think all these three, four conditions suggest that clearly the large cap is the better positioned risk opportunity in Indian equity markets today.
Sailesh, very lastly, as a fund manager, post the SEBI categorization, how do you manage your portfolio in large cap for alpha generation? I mean, given the current constraints as well.
The large cap space itself offers significant value and opportunity to create alpha, right? Alpha does not necessarily come from owning mid caps or small caps in the portfolio. It comes from also how you position your portfolio versus the index. If you look at it, what happened 2 or 3 years back when it was an extremely narrow market, right? And you got phenomenal opportunity to create alpha by shifting into the other side of the market within the large cap space. So large sectors today don't have representation in the indices, which in our opinion will do very well in the next 3 to 4 years. Like, the engineering and the whole manufacturing opportunity has very low single digit representation in the large cap index. So if active managers choose 3 or 4 very important areas, which can be strong earning growth opportunity in the next 3 4 years, alpha is there to be made even in large cap businesses. So it's about positioning of the product versus the index and the environment which supports it, rather than a category not being able to deliver alpha or being able to deliver alpha. So I think alpha lies if you're positioned well from how you read the economy in the next 3 to 4 years.
Right. Thank you, Sailesh. It was indeed a pleasure talking to you about the markets today. Thank you.
Thank you so much for having me.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.